you someone who has invested in penny stocks? Then this video is a must watch. For those who don't know what a penny stock is and why it is so risky, then follow along with us. So what are penny stocks? Shares of businesses with small market capitalizations that trade for pennies on the dollar are known as penny stocks. Although the definition of a penny stock varies depending on the context, these investments have a few characteristics in common. Penny stocks typically carry a high level of risk, in part because of their low price, which means that a change in the price of a few cents can significantly affect their worth. Because penny stocks are frequently traded over the counter, they are not usually as easy to acquire and sell or as strictly regulated as those listed on larger platforms like the New York Stock Exchange. When used historically, the term penny stock refers to shares of stocks that were traded for less than $1 each. But throughout time, the precise price at which an investment qualifies as a penny stock has changed. According to some government organizations, the phrase refers to anything dealing for less than $5. Some brokers have lower share caps of $2 or $3. While the phrase penny stock is absent from the US Securities and Exchange Commission's official consumer dictionary, a common synonym, microcap stock, is listed. A microcap stock, according to the SEC, has a market cap of less than $250 or $300 million. The market capitalizations of microcap stocks, according to the SEC, might be considerably lower. Are penny stocks worth the hype? Investors in penny stocks frequently purchase hundreds or even thousands of shares at once because of their low cost. Small changes in the stock price might therefore cause investors to make or lose a lot of money. Penny stocks appear to be an excellent approach to swiftly expand your portfolio at a minimal cost because they have limitless upside potential. But home runs in the world of penny stock trading are extremely rare, even while there might be undoubtedly cases of investors in penny stocks who became millionaires overnight. This isn't your ordinary stock buying journey either. The reason why penny stocks are so cheap is not because you're getting in on a great deal, but rather because the companies producing them are small and frequently unstable. In reality, they might already be insolvent or have filed for bankruptcy in the past. Usually, these businesses are too tiny to be mentioned on significant stock exchanges. They have occasionally been delisted or removed from an exchange or failing to adhere to regulations or keep a high share price. How does a penny stock work? If you invested $10,000 in a penny stock with a 20-cent pair price, you would own 50,000 shares, which is $10,000 times 0.20 equals 50,000 shares. If the stock rises just 10 cents to 30 cents a share, you'd have yourself a 50% gain, and your initial investment would now be worth $15,000. 50,000 shares times 30 cents equals $15,000. A very modest price movement in that stock could imply a huge percentage gain. You would have made a 500% return on your $10,000 investment if the stock ever rose to $1 a share, turning it into $50,000. What gives penny stock such a terrible reputation then? Using the same scenario as earlier, if the stock moved 10 cents the other way to 0.10 cents per share, you would find yourself suddenly facing a 50% loss, such as a small price change. What makes penny stocks so dangerous? To put it simply, dishonest individuals occasionally exploit these assets to take advantage of uninformed investors. Furthermore, investors' options are limited when a bad investment is made because penny stocks can be lightly traded and are subject to little oversight. Here are a few things to consider while considering penny stocks. Penny stocks frauds are common. There are plenty of results for penny stock scams on Google. The prevalence of scams is acknowledged by even the websites that promote penny stock trading as a sound investment strategy. Hollywood has also taken note, as fictitious descriptions of instances of financial institutions exploiting investors through pump and dump scams involving speculative penny stocks are the basis for movies like Wolf of Wall Street and Boiler Room. Penny stock warnings, particularly those regarding pump and dump scams, have been issued by the Financial Industry Regulatory Authority and the SEC. Scammers purchase shares of what FINRA has described as dormant shell companies with little to no business operations in such scams, and they then advertise the stock as the newest hot purchase. They sell their shares when the price increases, which drives down prices. The securities that are still held by the remaining investors are frequently worthless. These days, the promotion might be delivered via phone or email. The next big winner is often mentioned in scams where con artists pretend to be leaving a voicemail with a stock tip for a buddy. The number initially looks to be incorrect, but it piques your curiosity. Any stock, not just penny stocks, is covered by this. Consider the source and conduct your research if someone sells you a stock is popular. Penny stocks are difficult to verify. What if you have every intention of being careful and spend a lot of time frantically looking through penny stock listings in pursuit of your perfect investment? According to the Securities and Exchange Commission, one significant distinction between penny stocks and common stocks is a lack of trustworthy, easily accessible information on penny stock companies. Public corporations must submit regular reports to the SEC outlining their financial situation through audited financial statements. To be listed on major exchanges, they must also fulfill minimal requirements, which frequently include a floor for earnings. the number of shareholders, and the share price. And then there is the incentive and examination of stock analysis and experts who swiftly expose any flaws in the company. Over-the-counter trades are the primary method of penny stock trading. Major stock exchanges like the Nasdaq or NYSE do not trade the stocks that are posted on the electronic over-the-counter bulletin board system. They are therefore exempt from the same SEC regulations that apply to publicly available material. Even the most devoted investor might have trouble locating information about a penny stock company's internal operations, and the available information might not be reliable. Selling penny stocks can be challenging. If you choose to invest in penny stocks, keep in mind that you won't make any money on an investment until you sell it and make a profit. In the uncommon short-term scenario where you purchase a stock for $2 and it's sourced to $100, the $98 you receive is nothing more than a paper gain until you sell the stock and keep the proceeds. Low liquidity and excessive volatility are a risky combination that is present in penny stocks. Due to the aforementioned factors, as well as a limited market for these securities, they are frequently difficult to sell. The price may change significantly before you locate a buyer because they can be prone to huge and quick price swings. Alternatives to penny stocks. What are they? You should be aware that other investments are similarly inexpensive, but have fewer drawbacks if the low price is what draws you in. A fraction of the shares of a stock can be purchased from some buyers on dollar amount of your choice, such as $5 or $50, as opposed to paying the full share price. Additionally, think about exchange-traded funds. ETFs contain shares of the companies that make up the index they monitor, like the S&P 500. The share price for these funds, which might be substantially less than the normal minimal rate for index funds or mutual funds, is traded like a stock on an exchange. In other words, for a modest investment, you may instantly diversify. You could be able to invest in an ETF for as low as $20 or $30 per share, while certain ETFs will be more expensive than others, similar to stocks. Yes, that is more than one penny stock share, but in this case, you'll receive an interest in a group of listed regulated businesses. Do penny stocks ever become profitable? Yes, on occasion. But as we mentioned above, the SEC and FINRA both consider them to be very speculative. Despite the dangers, investing can still be profitable if you go by a few guidelines. Choose businesses that are SEC registered and submit frequent reports. Before making a purchase, research the firm and its senior executives. Know the market, how the business operates, and who its main rivals are. FINRA advises investors to exercise caution when purchasing newly issued penny stocks. Keep an eye out for warning signs. These include financial statements that lack auditor certification, have odd loans or rather transactions, are frequently changing, their name or business strategy have previously been suspended by the SEC, or have a promoter or office holding a sizable amount of stock. A Q, as the fifth letter of the stock symbol, according to the FINRA, indicates that the company has declared bankruptcy. Employ a trustworthy broker. If you do come across fraud, a good broker will assist you in taking rapid action. That's it, guys. Keep all the red flags in mind before investing in a penny stock. For more videos like this, subscribe to our channel, hit the bell icon, and stay hungry for more.